Here's the Advanced Projections report for March 2022. Please note that we have slightly delayed our regular March publication date due to our desire to include the results of yesterday's Federal Reserve FOMC March meeting information as reported on Wednesday. Since this announcement contains direction-setting information from the Fed, we deemed it too important to delay its inclusion until our April report. Thank you for your patience. February 2022 economic highlights in review. The Federal Reserve and the pandemic continue to exert their respective forces on the economy, but were cast into the shadows by Putin's invasion of Ukraine. Pandemic effects were far less related to illness than to residual supply chain and labor shortages, which we feel will continue to affect the economy for many more months. Equities hesitated as less than desirable inflation and pandemic news continues to be made, and the Fed meeting began to loom. Then the Putin invasion of Ukraine and the oil price shock it induced drove all three major indices into full-on corrections by early March. Inflation and employment figures for February came in at 7.9% inflation and higher than expected new jobs report up 678,000, thus pushing unemployment back down below 4% to 3.8%. These levels have the Fed fully focusing on inflation, as confirmed by Chairman Powell on March 2nd. We should all have been expecting the interest rate increases, which have now just begun on March 16th. The FOMC March 15th and 16th meeting has confirmed our expectations of a solid Fed plan of action to address high inflation as unemployment continues to stay below 4%. At this time, the FOMC announced an increase in the target Fed funds rate from near zero by adding 0.25% to that rate, with accompanying plans for additional increases in the near term. At the end of this report, we repeat and emphasize our historic warning based upon our expectations for an increase in the vigor of Fed upward interest rate moves and the international political and oil price shocks. These are precisely the something else that we said was required to kick the markets solidly into their long overdue corrections. Year-over-year consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirmed the onset of inflation during the second quarter of 2021, and they have continued to rise. February figures still came in hot at 7.9%. Unemployment's dip over the past several months is maintained, down to 3.8% unemployment, with new job gains in February of just under 678,000. We expect those gains to continue in a restrained fashion until the Omicron peak has truly gone later in March, and then bump up again with warmer weather. We have seen others project that unemployment will reach 3.7% by the end of the year, but our own figures fall into the 3.3 to 3.5% range, keeping labor markets very tight, barring anything expanding outside the borders of the sad Ukrainian drama. As we predicted last year, the Fed first announced in November that they would implement a gradual end to their asset purchases over the course of the next 8 months, going from $120 billion per month to zero in reduction steps of $15 billion. As we also anticipated, the December update from the FOMC described how the Fed was going to accelerate their plan, ending their asset purchases by March instead of June, and that it would be reasonable to expect 3 quarter-point rate increases during the remainder of 2022. The March 16th Fed announcement confirming what we had previously forecast, there will actually be 6 additional quarter-point increases in 2022, bringing the Fed funds rate up from near zero to about 1.75% by the end of the year. 10-year Treasuries have already begun to reflect more aggressive expectations, with a 35-point increase just in the first part of March. Many traditional investors use action in the 10-year Treasuries as harbingers of future equities market revaluations. First quarter corporate earnings estimates for 2022 have been tempered substantially. FactSet tells us this on March 11th. For quarter 1 2022, the estimated earnings growth rate for the S&P 500 is 4.8%. If 4.8% is the actual growth rate for the quarter, it will mark the lowest earnings growth rate for the index since Q4 of 2020, which was 3.8%. And that's the end of the FactSet quote. Companies have now returned to a more normal practice of citing lower expectations in the coming quarters. In recent earnings calls, over 350 of the S&P 500 companies cited inflation as a high concern, certainly with regards to material costs as well as labor costs and anticipated continuing upward pressure on them. COVID-related hospitalizations, ICU occupations, and fatalities of victims are overwhelmingly from among the unvaccinated. We quickly breached 950,000 U.S. fatalities in January, and the horrible milestone of 1 million losses will likely be reached by the end of March. Thankfully, the new daily fatality rates have now declined substantially in the past couple of weeks. Barring any nasty new variants that could still pop up, we should expect a general domestic return to normal for tourism and other social activities by mid-April, when the federal mask mandate on mass transportation ends, hopefully for good. Now, here are the current underlying socioeconomic details. First, the current employment picture. During February, unemployment levels moved back down to a national level of 3.8%, with a much larger than expected jobs gain of 678,000. That combination translated into more job seekers re-entering the jobs market. In spite of pandemic-related declines in the labor force, the participation rate began to move upward again, beginning in the late fall of 2021. Expectations for continuing improvement in employment and the labor force participation rate are still predicated on, in part, on several assumptions, including no new COVID crisis, the national infrastructure package, which will assist by adding at least $120 billion per year in stimulating project-related employment, and on increasing urgent corporate labor requirements to sustain their profit and revenue growth. Thankfully, Congress finally authorized government discretionary expenditures to the tune of $1.5 trillion in a bill earlier this month. Recent January 2022 Bureau of Labor Statistics estimates show that businesses have increased the number of job openings that they want filled, now up to more than 11.2 million openings. With this shortage of labor and with inflation pushing close to 8%, it would be reasonable to anticipate a much more adamant push for an increase in the federal minimum wage, probably to at least $10 per hour or perhaps even $12. This may also encourage the Fed to be a bit more aggressive in their rate increase script. Look for increased activity in these areas during the spring, assuming that the issues are not overshadowed by the Ukrainian situation. We have a table from the Bureau of Labor Statistics showing the employment situation at the end of February and the general improvements in the picture just within that past month. Briefly about the pandemic, by late February, total U.S. COVID fatalities reached over 960,000, up approximately 50,000 just in the past month. However, the new daily case and fatality rates have finally declined to less ominous levels. Our expectation for, quote, the end of the pandemic, unquote, barring any new super variants, is for the average U.S. daily fatality rate to fall below 400 per day and stay there. Still quite a horrific number, but within the ability of our social fabric to tolerate with the new and more effective treatments or preventatives that have come into being. See our written report for additional details about another page worth of material, as well as our ongoing fatality chart, which hopefully will be the last time we present that particular graphic. In equities, in February, during and through the early part of March, the equities markets continued on a volatile downward path, setting new 2022 lows in the last week of February, then testing them and breaching them in the first half of March. In the index decline so far in 2022, by March 8th, the Dow Industrials were down 11.3%, the S&P 500 was down 13%, and the NASDAQ was down 19.2%, all solidly into correction territory. S&P 500 earnings for fourth quarter 21 that have come in so far continued showing about 30% revenue growth from the fourth quarter of 2022, which was then the depths of the first COVID winter surge. FactSet has claimed the following on February 18th of 2022. For Q4 2021, the blended earnings growth rate for the S&P 500 is 30.9%. If 30.9% is the actual growth rate for the quarter, it will mark the fourth straight quarter of earnings growth above 30%. That's the end of the good news on earnings growth, though. For further comparisons down the road will be against the already improving quarters of 2021. With increased energy prices and interest rates on the horizon, energy companies and banks should continue strong in the quarters ahead. However, the broader equities markets should be looking 6 to 12 months ahead, where the estimates for S&P 500 earnings and revenue growth are far less aggressive, now in the vicinity of below 10% revenue growth with only 5% earnings growth. We have a chart from a couple of months ago, courtesy of FactSet, which puts the whole picture from 2020 through 2022 in perspective. These estimates may yet be revised further downwards as the Fed applies the brakes to the economy in the coming months. We are still due for a deeper correction in equities, but as we had cited earlier, a trigger would be required to really push it along. At first, the Fed's December accelerating rescript of their program seemed to only make the markets more confident, and it was very apparent that something else would have to come along to rattle the broader confidence of market speculators. That something else was the January-February Russian military buildup and the incursion over the borders of Ukraine, an accompanying oil price shock, and the increasing nearness of the impending FOMC interest rate hikes. We expect significant further declines. A return from the current still in the bubble territory to warm market levels would take the S&P down to about 3,500, and a correction just to the mean would be near 2,800. The typical bear market negative emotion moves carry enough downward momentum to drive indices below the mean, towards the inevitable emotion of capitulation when finally the selling ends. We won't speculate yet where the bottom might be, but this is our first shot at qualitatively describing where this big correction might go. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely strong leading symptom for a market correction. In December, margin borrowing dropped back a bit less than 1%, down less than 3% from October's all-time high, so this level remains very, very high. However, there was a more significant decline in January. We provide a chart of margin borrowing courtesy of Advisor Perspectives. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.